All right, so the balance sheet is split up into three main components. You got your assets, which in a nutshell is just stuff that the business can sell for money. You got your liabilities, which is just all the stuff the business owes. And you got your equity. Equity you get from taking the total assets and subtracting all the liabilities, and usually refers to how much money the firm has historically raised by selling its stock to shareholders, as well as how much of its earnings it's kept throughout its lifetime. Now, the thing I like to look at first whenever I look at a balance sheet is how much cash and how much short-term investments that the company has, because these things can be turned into cash almost instantly. And I want to look at that relative to how much the business owes within the first year and how much the business owes in total. So here with Google, we can see they have about $24 billion in just straight cash and about $87 billion in short-term investments. So these are like stocks and bonds that they can sell off right away to convert to cash whenever they want. So in total, that's about $111 billion or so, give or take. And if you compare that with their current liabilities, so these are all the obligations that the company needs to pay out within the next year, we can see that it's a lot more than $82 billion, which means they can easily cover their expenses within the next year. And in total, Google has about $119 billion in total liabilities. That's including everything they need to pay in the next year and everything they need to pay after that. And the $111 billion or so can almost cover the entirety of everything Google owes. So this is an example of a really healthy balance sheet. If I look at this, I don't really need to look further because I already know this company is in really good financial shape. Now, let's look at another company, General Motors. Now, if we look at General Motors' balance sheet and we do the same thing, and we look at cash and cash equivalents as well as short-term investments, this adds up to about $26 billion or so, $26.5 billion. And if we compare that to General Motors' current liabilities, let's take a look here. Oh dear, current liabilities is about $94 billion. Wow. So they have definitely not enough cash and short-term investments on the spot to be able to pay off all their obligations within that first year. Now, this means that General Motors doesn't have as good of a balance sheet as Google, but it doesn't mean that it's necessarily in any financial trouble. It's just that you have to do a little bit more digging than you would have to do for Google to evaluate how safe of an investment it is. Now, let's look at a third company, probably one of the most financially sound companies in the world, WeWork. That was a joke. Now, if we look at WeWork's cash and cash equivalents, it's about $287 million. And if we compare it to their current liabilities is about $2.23 billion. Damn. So this would be an example of a company that you just look at the cash and cash equivalents and you look at how much they owe in the first year, and immediately you should be getting a red flag. So, with these three examples, we basically found out within a few seconds that Google is a very financially sound company. WeWork is definitely not financially sound, but what about General Motors? Let's dig a little bit deeper into that. Okay, so to determine whether or not General Motors is financially sound or not, we have to look at the next item in the balance sheet, which is net receivables. Net receivables is the line item in the balance sheet that is a space to show how much money General Motors is owed by their customers. So if you have, let's just say, 100 dealerships that all purchase General Motors cars and they're paying General Motors within 60 days for their purchase, then that would show up in the net receivables category. With General Motors, I assume that because they're such a well-established company, they probably sell to so many dealerships that they're probably going to be able to collect most, if not all, of that money at some point. Now, if I'm still a little bit unsure about how reliably General Motors can collect on the money that it's owed to by its customers, I can do a calculation to determine its net receivable turnover ratio. Now, what the hell is that? Net receivable turnover ratio basically calculates how many times within a year a company collects on the money that's owed to it by its customers. We want the number to be as high as possible. Apple's is about 16 to 17, so they collect on the money that's owed to it about 16 to 17 times within the span of 1 year. Now, with General Motors, you can determine this, a rough approximation, mind you, by going to their income statement and take in the total sales. I'm going to take it for 4 years, 2023 to 2020, and you can just copy that here. And then I'll take the accounts receivables, net receivables over the course of 4 years, copy, paste, and I'll just do a quick Excel formula. This divided by this, and you get the net receivable turnover ratio. And over the course of 4 years, you can see that it's trending down, which is not a good thing. It still is in line with the average of 3.69. However, it means that over the course of 2021 to 2023, General Motors is a little bit slower in collecting this money from its customers. What that means, I'm not totally sure, but it does create some cause for concern. This is starting to create some yellow flags for me here. Now, the next thing we want to look at is inventory, because other than net receivables, inventory is the next item that is a little bit trickier to convert than accounts receivables. It's basically, in General Motors' case, all the cars that they have stored that they're waiting to sell. And inventory is another thing that you have to evaluate. How likely is it for the company to be able to turn this into cash within the next year? Looking at this trend, I can already see a little bit of a concern here. I can see that inventory has gone from about 10 billion in 2020 to about 16 billion in 2023. Normally when inventory increases, and let me take a look at their earnings since 2020 seems to be, it's usually about $9 to $10 billion, it looks like. 2020 was probably an anomaly because pandemic, right? So they make about $9 to $10 billion, and then inventory has been going up steadily, which is a little bit of a cause for concern. Whenever a company starts to build up inventory, it usually means that they're having some trouble offloading it. Now, if I wanted to evaluate whether or not the inventory buildup is a problem, I can look at something called the inventory turnover ratio, which is how many times within 1 year a business turns over its inventory, like it sells everything that it had in its inventory. So in General Motors' case, we can calculate this by going to the income statement and taking their cost of goods sold and copying and pasting it here. And then at the bottom, we can take the value of their total inventory. And if we divide these two numbers, we get the inventory turnover ratio, which is you take this number, you divide it by that number, and you get this. So it's about, roughly speaking, between 8 to 10, which is relatively healthy. It means that within 1 year, if you take 1 year and divide it by 8 or you divide it by 10, it means it turns over its inventory every maybe 1 to 2 months, which is, decent. It's not bad. But I am a little bit concerned about why they're keeping more inventory now compared to maybe 2 or 3 years ago. It might be something worth digging a little bit more into, although based on my calculation of the inventory turnover ratio, I don't think it's something that's necessarily super concerning in the near term, but it could reflect something long term. Now, after doing all those calculations, we can see that General Motors' current assets, when you add everything up, I'm just going to ignore other current assets for now. If you want to know what this actually is, you'll have to go into their annual report or something to actually see it. But let's assume we add everything up when we get the total current assets of about $101 billion. And from that, we can see that the cash and cash equivalents and short-term investments, this is going to translate really well. And we found that for net receivables and inventory, that even though there might be a little bit of a concern of whether or not they're going to get that money, most likely they are going to within that year. So then we'll take this total number and we'll compare it with their total current liabilities, which is all the money that they need to pay out within that year. And we can say that it is definitely higher, which is good. It means that General Motors within 1 year is unlikely to run into any serious financial difficulty. And it's this point where I would want to look at their income statement and see whether or not they're profitable. And we can see General Motors is consistently profitable over the last 4 years, which makes me feel better. If the company had only slightly more current assets compared to current liabilities, and I found out that with the receivables of the inventory, there's a small chance that something might happen or there might be something worth looking into, and I find the company isn't profitable, then it makes me more concerned. But the fact that General Motors is consistently profitable makes me reassured that within that year, I don't think anything's going to happen to this company. Now, this brings me to one of the important ratios that I look at when I look at a balance sheet, and that's the current ratio. And that's you taking their current assets and dividing it by current liabilities. Generally, if this number is above 1, it means that the business is at least probably not going to go bankrupt within that year, which is the bare minimum if I'm thinking about investing in a company. But as you can see, based on these 3 examples with Google, with WeWork, and with General Motors, you have to do a little bit of further digging. In Google's case, they had so much cash that we didn't even need to do any further digging. We know that they're good. With WeWork, I mean, yeah, we looked at it right away and we saw they had so little cash versus the money that they owe that there's definitely something wrong there. And with General Motors, you had to do a little bit more digging. You can't just do this simple ratio and just divide current assets by current liabilities, because you need to know how well they are going to convert their accounts receivable, which is the money that customers are owing them, as well as how well they're able to convert their inventory into cash. Because a big problem is if you have a company that shows high current assets but they have a huge inventory buildup that they can't actually unload, that might be the case where they might have a positive current ratio but the business might still run into financial troubles within that year. So for certain companies, as in GM's case, you have to do a little bit more further digging. You can't just use a simple ratio. So once I'm finished with looking at the current ratio, the next thing I want to evaluate is the property, plant, and equipment. One really important thing to note about looking at property, plant, and equipment is that the value that you see in the balance sheet, called the book value, is often very different from the market value, which is how much that property, plant, and equipment can actually sell for. So in companies that are growing and are in fast-growing industries like Google, for example, their property, plant, and equipment is often understated on their balance sheet because that's the cost that it took them to actually build/acquire that asset. If Google were to sell some of their data centers, there's a good chance that they would actually be able to sell for more than how much they used to actually make it, because let's just say Google built some data centers for AI, and AI data centers are really high in demand. How much they're going to sell that for is probably going to be higher than what's listed on their balance sheet. On the other hand, if a company is in a stagnating industry, let's just say they're like a steel mill or something that's becoming obsolete, or they do like textiles or something like that, their property, plant, and equipment is not going to sell to their book value the same way that Google's property, plant, and equipment is going to sell for. It's probably going to sell for either at market value, or it's going to actually be below the amount that's actually stated on their balance sheet. And if a company is going through bankruptcy, oftentimes their property, plant, and equipment is sold at a hefty discount because they just want to get rid of it ASAP. Now, one thing I like to do when I'm evaluating the property, plant, and equipment is I like to look at the total value relative to how much money the company's making. So in Google's case, we can see that the property, plant, equipment minus the depreciation is about $148 billion. Now, if we look at the income statement and we see Google made last year about 73 or 74 billion dollars. So they only needed about 140 billion dollars in property, plant, equipment to make about 70 billion dollars. That is a testament of a really efficient business, that they don't really need that much property, plant, equipment in order to generate money, which means the business is a high quality business and it doesn't need to invest a lot of money in order to generate really high earnings. So this is related to return on invested capital as well. It means that the Google doesn't need to take on debt, or they don't need to spend a lot of money on rejigging their data centers every few years or every year. It's a business where you don't have to actually spend that much money to make money, which is good. Now, typically businesses like Google that have a very high return on their property, plant, and equipment, they have very low debt because there's no reason for them to go into debt in order to grow their business, because the company's making so much money relative to how much assets it has that it can often self-finance its own growth. And if you look at Google over here, let me just pull it up, the total long-term debt is about 11 or 12 billion dollars, which relative to the market value of over 1 trillion, I would say it has very low debt, and that's a testament to it being a very high quality, efficient business. Now, let's evaluate the property, plant, and equipment line item for General Motors. So you can see here that General Motors has, in its property, plant, equipment, roughly $80 billion once you subtract depreciation. Now, if we look at relative to how much of its earnings come from the property, plant, equipment, it's about 10 billion. So in Google's case, they have about 140 billion dollars in property, plant, equipment, and from that they can generate 70 billion. With General Motors, they have about 80 billion of property, plant, equipment, but they only generate 10 billion out of that. So comparing these two businesses, Google is a much more efficient business and they don't need to invest that much capital to generate a huge amount of earnings. General Motors, on the other hand, it's the completely different story. They need to put a lot of money into maintaining their factories in order to generate a very small amount of money relative to how much they're investing. And normally, when it's the case of these businesses that are not very efficient in using their assets to generate earnings, usually these companies tend to take on a lot of debt. And if you go into their balance sheet, you can see that General Motors has about $83 billion in long-term debt. And that's because these companies, they're not able to self-finance their own growth. In order to grow more, they need to borrow more money to put into investing in their property, plant, and equipment to generate a very incremental increase in their overall earnings and in their overall growth. Now, there are two simple formulas that you can use for determining how efficient a business is with getting more earnings from capital being invested into it. One of these is the return on assets, where you take the total earnings that the business generates and you divide it by their total assets. Another version of this is the return on equity. You take the total net income that the business generates and you divide it by the equity. So these are just a few formulas that are often used interchangeably to evaluate how high quality a business is based on what I've just mentioned with the previous examples. And in general, the higher these numbers are, the higher quality the business is. However, there is a little bit of nuance to this as well. You can't just use this formula blindly and just blindly invest in the company with the highest return on assets. You have to analyze the moat of the company. Because if the company doesn't have a sustainable competitive advantage and it has a high return on equity, this might go down in the future as more competitors enter that industry. So you really have to use these formulas in conjunction with your own research as well. Now, looking at long-term debt, generally, because long-term debt from a company tends to signify that the business is lower quality. It has lower return on assets, so they have to take on debt in order to grow the business. So usually when I see long-term debt in a business, it doesn't give me a very high opinion of that business. There are a few exceptions though where I will consider buying a company with significant amounts of long-term debt. This is if the debt was taken on for another reason that's not growing the business. So for example, if a company was taken over through a leveraged buyout, or if there was some corporate event that caused them to take on the debt, or if, for example, the company engaged in an acquisition and they borrowed money to do that acquisition, and I evaluate that the acquisition is good for the business, those are the few cases where I will consider investing in a business with high long-term debt. However, there's a few caveats here that we need to consider. Now, if a company has long-term debt, the first thing I want to find out is whether or not they're profitable. Because if a business is significantly in debt and it's not making money, there's only one way this can go, and that's the bankruptcy court. In General Motors' case, if I take a look at their income statement, I can see they're generating about $10 billion in profits. So the fact that they have $80 billion in long-term debt, I mean, it does kind of suck, but at least General Motors meets that first requirement, which is it's profitable. With long-term debt, the two most important things to find out are, number one, what the interest rate on the debt is, and the second important thing to look at is when that long-term debt is due. Generally, if you're investing in a business, you want the interest rate to be as low as possible and be due in as much time in the future as possible. So the company isn't going to run into a situation where they have a ton of short long-term debt that becomes due in 1 year and maybe they can't afford it, or maybe the interest rates go up and they can't refinance that debt. Now, generally, you can find out all of that information on the long-term debt of the company just by looking at the annual report. So here I have General Motors' annual report over here, and it tells me generally when the debt is due as well as the interest rates for all of their debt. Now, let's go into the last little part, which is, I'll just put all these together: goodwill, intangible assets, and other long-term assets. So what's goodwill? Goodwill is basically when a company acquires another company, it's how much more they paid for the assets of that company relative to the book value. So for example, if a company buys another company and that company has, let's just say, $5 billion in total assets, but the company was acquired for $7 billion, then that $2 billion will turn into goodwill. An important thing with goodwill and intangible assets are basically assets that can't be turned into money very quickly. So things like a company's brand name or like patents or something like that. Generally, goodwill and intangible assets, they're very difficult to turn into money. And when you evaluate how financially stable a company is, I often take out goodwill and intangible assets because I know how difficult it is to convert this into cash. So if a company, for example, has about $3 billion in assets and $3 billion in liabilities, but the goodwill is about $2 billion, then I know, even though they have roughly the same amount of assets versus liabilities, that the company is probably in some serious financial trouble. So that's basically it with goodwill and intangible assets. Another thing that's important is every now and then you'll see a company write down their goodwill or write down their long-term assets or their intangible assets because they feel that the value has declined from a few years ago. Or they might amortize that on their earnings, so it can cause the earnings during that time to be deflated. So generally, when I look at the earnings of a company, and this is maybe a conversation for when we cover the balance sheet, I try to overlook some of the effects of amortizing goodwill or writing down goodwill if I think that this is probably just an effect that's temporary. Now, if a company has a really high amount of goodwill and intangible assets, you'll need to do some digging in to figure out how they actually got it. If a company has a high amount of goodwill, it means they did a lot of acquisitions. So, a good thing to do is to then go over all the acquisitions that they made and see and evaluate whether or not it was good for the long term health of the business. Similar to long-term assets, oftentimes businesses, when they purchase long-term assets, they might write it down in the future if they feel like the values decline, or that long-term asset might actually be worth a lot more than it's shown on the balance sheet. So one thing you need to do as an investor is to evaluate how good a business is at acquiring other businesses, how well the business is at making these long-term investments. And there's no real simple answer to it. You kind of have to dig through every single case and evaluate it. However, if you do see that a company is consistently writing down their goodwill and intangible assets or their long-term assets, and they're writing it down over a long period of time where they're saying, okay, we thought it was worth this much and we were mistaken, and it happens for a lot of acquisitions, then that's a pretty big red flag there that the management might be a little bit, how do I say this, not very smart. The last thing I take a peek at once I've looked at all the other important items is the company's retained earnings. So in the shareholders equity section, you'll see a section for common stock, which is all the money that the company got from selling its shares to the public. And you have your retained earnings, which is all the money that the company kept from making money that they didn't actually spend. They just kept reinvesting into the business. So generally, I want to look at retained earnings and I want to see it consistently be growing over the years. So here we can see Google increased their retained earnings from about $163 billion to $211 billion. So this is a mark of a healthy company that's continuing to grow and continuing to make a lot of money and reinvesting that company back into the business. If we look at General Motors, we can see that it's been increasing its retained earnings as well, which shows that the business does have a track record of profitability. However, if we look at that other example that we saw and we look at WeWork, let me just take a look here. We can see that in its retained earnings, it's been consistently trending in the negative direction, which should be a red flag for any investor not to ever invest in a company where their retained earnings are going down every year. Of course, there are these tech companies and these early startups which incur a lot of expenses in the beginning and then later become profitable. But when you see retained earnings going down or being negative and more negative year after year, usually is a little bit of a red flag or yellow flag, at least to show that the investment is quite risky. All right, that's all for today. Thank you so much. I hope all of you learned a lot from this video. And if you did, please give it a thumbs up, like and subscribe, and I will see you guys all later. Please comment down what you would like to see and if you would like to see a similar video on the income statement. All right, thanks everyone. Peace out. Bye.